Housing prices continue to grow at a rapid pace, and there's always commentators, economists from banks that come out and say, this year it's different. We are going to drop by 15, 20, 30% in prices because of so and so reason. Every year they seem to be wrong. So in this video, what I want to do is go through a couple of graphs, because you guys apparently love them, is to go through a couple of these and understand why housing just feels more expensive every single year and how it feels like we're always left behind. If you're not in and you don't have assets, it's almost like you're always in this race to try and get that first deposit. So let's break down why that is the case. If you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now in this video, what we're gonna do is we're gonna look at why housing always feels like it's always too far. A bridge too far, a mountain too high to climb. I don't know what else you're gonna say, but essentially it feels very difficult to go in, not only to purchase a place, but then to also scale up and build a property portfolio. It can be quite difficult. Now, before we jump in,
we look at some numbers and some fancy graphs.
I just want to remind you that if you are interested in upgrading your financial mindset, getting more information like this, but on a daily basis, then there's a link in the description below. Join Patreon Premium. That's basically where I'm talking about things like cryptocurrency, NFTs, bringing it together for housing and real estate, and conversations around how we can utilize what's happening in the macro environment to go in and really kick some goals in 2022. So if you want to check that out, there's a link in the description. If housing price growth seems unusually high, that's because it is. Over the past year, housing prices have grown at the third fastest rate in Australia's history. Capital city dwellings surged by more than 20% over 2021, while in regions, median house prices increased by 25%. While the escalation of Australian house prices is a widely reported phenomenon, understanding past episodes of growth gives us insight into how remarkable this period has been and what might come next. Housing price growth is a modern phenomenon. Using the work of Nigel Stapleton, who pieced together records of property sales in Sydney and Melbourne from newspaper records, we can get a view of Australian dwelling prices from a period before Federation. On this timeline, units are a relatively modern addition to the housing stock, so we stick to analyse house prices. After accounting for general price inflation, we can see that price of houses didn't change much throughout Australia's early history. It wasn't until 1950s that prices started to increase relative to other goods. Prices rose gradually at first, and then since the late 1990s began a period of very strong growth. Now, I haven't read this article, so I'm reading it for the first time with you guys, but it'll be interesting to see if they go down the path of why inflation is in the system, how people are using their cash, hoarding it and saving that money, but realize that over the long term, inflation actually kills off the value of your currency. So it's not almost like the prices of assets are going up, it's just that they're moving a lot faster than wage growth and the value that your currency actually holds. Now, if there's inflation in the system, which, the RBA comes out and says we aim for 2 to 3%, that means your dollar is losing 2 to 3% every single year. So this is where I come back to you guys and say, look, saving is a good habit, but if we aren't using that money to go in and invest into assets, then we're doing this wrong. Why would you hold an asset that continues to go down in value by 2 to 3% on its own value? Then you put it relative to other costs, like cost of living, cost of goods, and then housing, where housing is increasing by 10, 15, 20%. You're actually losing and compounding that growth. Now, I'm not a financial advisor. You guys know that by now. I wear a black t-shirt from Kmart and I don't have a fancy piece of paper on the wall, which means I am not a financial advisor. You should definitely go do your own research. Now, this graph looks amazing. Inflation adjusted house prices from March 2011 to currently in 2020. So it's just very interesting to see the rate of growth. As you can see, before 1950, nothing's really happening. We've picked up some sort of growth from like the 1950s all the way into, say, the 1980s. And then we've just been on this parabolic run. Like if this was an actual crypto coin, I would definitely not be investing in this. But this is where context comes into play. Why is this happening? Well, this would have an inverse relationship with our currency value. So if you're seeing this go up for housing, it's probably doing the opposite for our actual currency value. It is useful to understand how the housing market has changed along this very long time frame. Before the 1950s, land on the fringes of urban cities were close to CBDs and relatively cheap, which kept a lid on house prices. Once land close to the cities became more scarce, along with the high levels of immigration into Australia in 50s, 60s and 70s, prices started rising at a faster rate. This is that old concept that I keep talking about every single video, and some of you guys may be like,
I'm so sick of hearing this.
supply versus demand. It's simple as that. If there is more demand than supply, prices will go up. That's just how it works. It's the basic law of economics, and that's exactly what happened here. But prices were modest compared with recent history, as higher demand was partly matched by improvements in transportation technology, car availability, and the growth of tram and train networks, which allowed more accessibility to further flung suburban fringe regions. The past year has seen the third strongest episode of annual growth in history. Annual growth in these long-term prices highlights some interesting periods in Australia's housing market. The past year now ranks as the third fastest episode of annual price growth on record. And here we can see Australian long-run house price adjusted for inflation. You can see that in 1950 we've had this enormous run up, 111%, and it's due to the reasons of supply and demand. We've got scarcity in what's available, but we also don't have modern transportation. We don't have those links with being 30 or 40 kilometers away. I remember when my parents bought a place, now we're talking about 25 years ago, when they bought a place out in like the southwest of Sydney, to actually get there by normal roads, some of the roads were like a bit shonky, and it usually used to take like an hour to get. But now, if I was to travel the same distance, I'd go on the motorway, get there in about 20 minutes. We then had a peak in 1989, and now we can see how strong this actual growth is. So, the question that most people come to is, well, we've seen that once we have that spike in growth, it usually calms down. And that's the sort of stuff that we're going to figure out as we go through this video. Looking at the highest episodes of price growth provides some comparison of how extraordinary the past year has been, and may give us some insight into what might follow in the coming period. The end of wartime price controls in 1950. Wartime powers brought rents and house prices under the control of the Commonwealth during and after the Second World War. Under these powers, houses could only sell for 10% above the value provided by an approved valuer.
That's phenomenal.
So I hope that's something new that you take away from this video. I didn't know that. With consumer prices rising by 30% between 1942 and 1949, approved values failed to keep up with the underlying market. And this is so interesting. If you actually look at what was there before to what is there now, we're looking at Australia's developed rapidly image of broad meadows in 1950s to the present day. Just shows how much there is a demand for housing because our population is growing, but also because we have immigration coming in. We're trying to grow the country as well, and there's the demand right there. The government called a referendum in 1948 to amend the constitution and grant permanent powers to control rents and prices. But when that was defeated, price controls were repealed in 1949. In 1950, with no more controls, prices doubled, and this represents a one-off catch-up for the falls in inflation-adjusted prices throughout the 1940s. So it's interesting. It's almost like a slingshot happened at that time, and that's when we refer back to this graph to see it go up so quickly. That's explaining why that peak happened. Now, when we're coming to present day, why is the peak happening and why has it occurred? Well, it's a direct correlation between what was being printed and how much money came into the system. Everyone was making money just by sitting at home, when in fact we had lockdowns where there was no economic activity. When you have no real economic activity, you've got to then artificially create that, which is essentially what JobKeeper, job seeker payments were. So once this came into the system, people felt like they were richer. They could now use that money to come into the system and then generate economic activity. And this is where the rich got richer and the poor got poorer, because the poor people almost needed that money to go, I need to pay for rent, I need to pay for food because I'm not working anymore. Whereas some people that became richer had assets, and the assets grew in value because there's more money supply, the rents went up in value, then they went ahead and they actually had different sources of income that allowed them to stay above board, and they had discretionary income, which allowed them to go into an area and go,
well, I could just continue investing.
Whether that's stocks, whether that's ETFs, whether that's crypto, or whether that's housing, they just made enormous amounts of wealth during this time. This is from a newspaper in 1965. Now, for those who live in Sydney will be very familiar with this and might cringe, but here we go, is in Maroubra, you could purchase this house, which is a 3-bedroom brick home, for £8,300, which in today's value would be about $20,000 to $25,000, which is absolutely insane. Ashfield here, the inner west of Sydney, is £6,800, and that again is for a brick home. And to give you context, this is in 1965, so on average, $20,000 to buy a house. Fast forward to today in 2021, that same house would sell for about $1.2 to $1.6 million. Absolutely crazy. You've also got Caringbah and Beverly Hills with similar prices. What you'll also find is that the prices are very similar despite their location in Sydney. Like Beverly Hills is not very close to Ashfield, and then when you look at it in comparison to the CBD, it's also not very close. Then you got Maroubra, which sits near the beach as well. So it's very interesting how the pricing worked and how people valued certain areas over others. It seems like it was almost a blanket rule there. So in 1989, we saw the second big peak. And why was that? Well, inflation-adjusted house prices were fairly stable through 1970s and 1980s, but in the late 80s, prices boomed. The preceding decades represented a significant deregulation of the finance industry in Australia. Large innovations such as the removal of limits on interest rates that could be paid on deposits and charged for loans, the floating of the Australian dollar, and the introduction of competition from foreign banks significantly modernised the sector. These changes spurred improved access to credit and helped facilitate the housing price boom at the end of the decade. Now, the reason why we're going through this, and I know some people will be like,
I don't care what happened like 50 years ago.
I think it's very important to understand why certain things happen. It's what I've tried to preach on this channel. I try and give a little bit of context, make it so it's simple for you guys to understand and hopefully entertaining enough for you guys to smash that like button, and then we can formulate how we best prepare for what happens next year. The price growth culminated in the financial crisis, where banks lost significant amounts of money and two failed entirely. But these losses were primarily due to commercial property rather than residential real estate. Losses on assets exceeded 50%. The losses brought about a financial crisis and recession, which weighed on house prices in the following years. 2021 and beyond. PropTrack data for the September quarter of 2021 suggests capital cities grew by 22% over the year in inflation-adjusted terms. This is the third fastest episode of the house price growth in Australia's history. The past year has certainly been unique to the two episodes of faster house price growth. After falling initially after the onset of COVID-19 crisis, prices have shot up sharply. So this is interesting because I'm not sure where they're referring to in terms of prices falling and when this actually was. For me personally, I've got real life experience because in Feb and March, when COVID was around, it started coming into effect here in Australia. I actually went out and made my biggest purchases in real estate. Why? Because for me, I had conviction around what I was looking at in the market. I understood that if we were going to have this issue where things were going to get locked down, there could be a possibility that prices fall. But if we then have introductions of things like loan deferral repayments, we've got artificial stimulus payments being paid to people so that they can stay at home, I understood that in the short term, we might have some price volatility. But in the long term, this is actually just going to become a slingshot for price growth because we've got so much money in the system, people are going to want to use that to then grow their asset base because that's where they get the return on their investment. I also knew that the way that we had lockdowns, everyone was not going to be affected the same way. So the people that weren't affected were like, hey, I'm so much richer. Let me go and use that equity in my house and go purchase more assets. Exceptionally low borrowing costs, as well as the ability for people to work from home, have driven both generalized price increases across the country and put particular pressure on regional areas. As you know, I've been talking about regional areas for like the last 18 months since I started the channel really. And the reason for that was one, we already saw growth in regional areas, just nobody was talking about it. And for me, I've always invested in regional areas. Yes, I dabbled into the capital city market as well, but for me, it just made sense that if I get cash flow and get capital growth, it means it doesn't affect my lifestyle. That's why I talk about it. That's why I was doing investing and scaling up my portfolio. But two was that once lockdowns actually kicked in, it meant that there were people moving out into the regional areas, and that meant more pressure on the already shortage of supply in properties that were in these areas. So that just meant that there was even increased demand for the supply that was already in shortage. Strong price growth has often preceded falls. Is that in store again? That's really the question here. In a short sort of video, we've understood why it's happening, but can we figure out what happens next? The previous episodes of very strong growth have been followed by price falls. While property prices are notoriously difficult to forecast, it is hard to see the same downturns befalling the current market, at least in the near term. The outlook for price growth in the coming period appears solid, if unlikely to be as exceptional as what we've seen over the past year. While the large number of property listings, particularly in Sydney and Melbourne, as they come out of the most recent lockdowns may put downward pressure on prices, these remain very high numbers of buyers in the market on realestate.com.au waiting to find their new home. Essentially what this means is that yes, we are seeing increase in supply in Sydney and Melbourne because we've got now lockdowns ending. People are like, okay, I can finally resume my plans that I had from 2019 and now I can do them now, which may have included them moving out or moving overseas. Although there is an increase in listings, there is still a lot of buyers in the market. Now the question is that as increases in interest rates happen, as there is more uncertainty and the news articles that come out, as well as people on Channel 9 talking about how everything's collapsing, could this number reduce? And if it reduces, then what happens to property prices? If we do see the reduction in demand and we have that increase in supply, then we will see a slowdown and potentially see falls in prices. APRA has implemented some tightening of credit conditions, but overall borrowing conditions remain very favorable. And the Reserve Bank recently reaffirmed its expectations that real interest rates would not rise for another 2 years at least. Who knows what the next 140 years of Australian housing may hold. So a very interesting take, and of course you're here to hear my conclusions. If you're still hanging around, you enjoy this video and you haven't smashed that like button, please do. If you're new here, subscribe because I bring out about 3 videos every single week. My thoughts are very clear, is that next year in 2022, we're gonna get more periods of uncertainty. Not because there's lockdowns, but more so because we don't really know when the bank's coming out and increasing their fixed rates, but then the RBA's coming out and saying, we're not increasing our cash rate. What does this mean? And for most people during the last 2 years, it was the first time that most of us even heard about what stimulus was, what inflation was, what money supply was. So now heading into a period of, uncertainty, plus people actually being out and about and traveling overseas, there's going to be less attention on things like finances, and I don't think that should be the case. I think now more than ever, people should start really focusing on their financial education, because if we don't pay attention to what happens in the next 2 years, if we do suddenly see a shortage of supply and we see an increase in demand because we have immigration coming in, there's going to be this emotional effect of FOMO where people are going to go, well, property prices keep increasing despite interest rates going up. I need to buy right now. It's going to get crazy. So buy when the smart money is buying and avoid the areas that come out in these news articles that will say, these are the best areas, these are the best suburbs. I did give a breakdown in the Patreon community about why I was avoiding certain areas. So again, if you are after that sort of information, that's where I am posting every day. But for me, I'm not personally worried. In Q1 2022, I am back in the market personally buying property for myself. And if I could buy right now, I would. But right now, my attention is on crypto. And if you haven't already, subscribe to the channel. I talk about crypto, NFTs, and occasionally I'll talk about Pokemon cards too. I hope you guys have enjoyed this video. I know it's a bit lengthy, but context is key. I'll catch you guys in the next one. Thanks, guys.